Asset allocation involves dividing an investment portfolio among different asset categories to balance risk and reward. It is crucial for effective risk management and achieving long-term financial objectives, as it aligns the portfolio with an investor's goals, risk tolerance, and investment horizon. There are several types of asset allocation strategies. Strategic asset allocation is a long-term approach that sets target allocations and periodically rebalances the portfolio. Tactical asset allocation adjusts allocations based on short-term market conditions to capitalize on opportunities. Dynamic asset allocation continuously adjusts allocations in response to market performance. The core satellite approach combines a core portfolio of stable assets with satellite investments in higher-risk assets for additional returns. Strategic asset allocation establishes a base policy mix of assets based on long-term goals and risk tolerance. The key steps include determining target asset allocation percentages and periodically rebalancing the portfolio to maintain these targets. For example, an allocation might consist of 60% equities, 30% bonds, and 10% cash. Let's implement a strategic asset allocation for a $100,000 portfolio. We determine the target percentages for equities, bonds, and cash, allocate funds accordingly, and periodically rebalance the portfolio to maintain these targets. This example demonstrates the initial allocation and rebalancing process. Tactical asset allocation adjusts asset allocation based on short-term market conditions to capitalize on opportunities. The key steps include monitoring market conditions, adjusting allocations to exploit short-term opportunities, and returning to the strategic allocation as conditions normalize. For example, increasing equity allocation during a market rally can enhance returns. Dynamic asset allocation continuously adjusts allocations in response to market performance. The key steps include regularly reviewing market performance, adjusting allocations to reflect changes in market conditions, and maintaining flexibility to adapt to new information. For example, reducing equity exposure during a market downturn can help mitigate losses. The core satellite approach combines a core portfolio of stable assets with satellite investments in higher-risk assets to enhance returns. The key steps include establishing a core portfolio with a diversified mix of stable assets, selecting satellite investments to boost returns, and periodically reviewing and rebalancing both core and satellite components. For example, a core portfolio might consist of index funds, while satellite investments could be in emerging markets. Asset allocation strategies include strategic, tactical, dynamic, and core satellite approaches. Implementation varies based on investment goals, risk tolerance, and market conditions. Practical examples demonstrate how to allocate and rebalance portfolios using different strategies. Python integration facilitates the calculation, visualization, and adjustment of asset allocations, enhancing portfolio management.